Hello, everybody. My name is Anthony Kazazis, and I am the director of the NYC Network Group, as well as the NYC Real Estate Expo. And I want to thank you all for coming on and registering for today's webinar, Capitalize on Opportunities with Non-Owner Occupied Investment Lending. Mortgage professionals are doing more business than ever in this booming segment of the market, and so can you. You'll learn today from seasoned industry professionals about what resources you'll need to drive into this space and how to start making more money today. Our two sponsors today for the webinar are RCN Capital, is a nationwide direct private lender established in 2010. They provide short-term fixed and flip financing and long-term rental financing for real estate investors. The loans they provide are often called hard money loans. They can be used for the purchase or for the refinance of non-owner occupied residential and commercial properties, financing of renovation projects, and bridge funding. RCN lends to real estate professionals, commercial contractors, developers, and small businesses owners throughout the country. Our other sponsor today is the moderator, as well as Susan May-Mclean, who for 20 years ago, she founded Horizon Land Services, which provides residential and commercial title insurance nationwide. Susan thrives on connecting people and has been the bridge for countless business relationships. And I could definitely attest to that. And I'm very happy to have Susan here today as our moderator. Here today as well to discuss the topics, we have Jeffrey Tesch, CEO of RCN Capital, John Hornik, Esquire, partner attorney at Private Lender Law, Timothy Maloney, president of Quickline Capital Partners. Guys, let's start off with Susan. Just a 1-minute intro. Please tell us about yourself.
Sure. First of all, thanks, Anthony, for pulling this all together as usual. I founded Horizon over 20 years ago. It's been quite a ride. We've seen a lot of different things over the past 20 years happen, but nothing like this. As you said, Anthony, we do residential and commercial nationwide, non-performing nationwide. And my staff, everybody, we've been together. There's one person who hasn't been with me for under 12 years. So it's like hanging out with the Rolling Stones. It's kind of fun.
Thank you, Susan. Jonathan.
Anthony, how are you?
How are you?
Great today. Good morning, everyone. Everybody watching today. My name is John Hornik. I am the founding partner of our firm, LaRocca, Hornik, Rosen, and Greenberg, but my department, which specializes representing private lenders, goes under private lender law. We have a national practice with offices in New York, in the Trump Building, and in New Jersey. We represent over 60 originators actively nationwide and close 500 plus loans a month in the short-term bridge, DSCR, and fix and flip space. A couple things I want to say. Jeff Tesch is a dear friend of mine from RCN. We've worked together since RCN's inception, and here's a tidbit fact. It used to be known as Entertainment Financial. So that'll bring a smile to Jeff's face. And I look forward to a spirited discussion about what's going on today in the world.
Thank you, Jonathan. Tim?
Anthony, good morning. Thank you. So I'm the president of Quickline Capital Partners. Before Quickline, I spent 20 years in private equity and decided to break off on my own. When I did, I was sort of servicing all sorts of debt and sourcing all sorts of debt for consumers. Probably around 5-6 years ago, sort of made the jump, and really now our entire focus, 95% of our revenue is from commercial real estate, be that fix and flip, bridge loan, 30-year, and so on. I do source a lot of the capital from RCN Capital. So Jeff Tesch and I are close friends here, or at least I like to think so. In Quickline today, we're busier than ever. As we were talking about before this call started, there's a lot of momentum in the market right now, and as inventory is becoming available, we're basically poised for an incredible 2021.
Thank you, Tim. And Jeffrey.
Hey, good morning, Anthony. Nice to see you. Good to see everybody this morning. Really miss what you put on in Manhattan every year. Thank you for your leadership in the space. To everyone on the call today, if you haven't had a chance to experience one of Anthony's shows in Midtown Manhattan, there's nothing better from a networking perspective from doing that handshake, trading business cards, from the granular mom and pop shop out in Brooklyn to the Titans in Manhattan. Everybody is at your shows, Anthony, and I really appreciate your leadership. Thank you so much.
Yeah, thank you, Jeffrey.
Myself, Jeffrey Tesch, CEO of RCN Capital. We formed our company about 10 years ago. We're based out of Connecticut, just outside New York City. We started a firm really attempting to take the owner-occupied loan, turn it into a non-owner occupied loan from a professionalism standard. We wanted to elevate that asset-based lending to a commercial status for all of the foreclosures that were happening across the United States, and really pleased with the product that we've turned out. We're lending across America today, have about almost 150 employees, funding from coast to coast. We are a big-time wholesale lender working with our partners coast to coast, providing that capital that we need with a special emphasis in the greater New York City area. We've been here since the beginning. We love it, and we're here for the long haul. So looking forward to the panel today, Anthony.
Yeah, same here. Thank you, Jeffrey. Guys, we're going to let the panel run out for about 45 minutes. And right afterwards, please put your questions into Q&A. And then right after the end, when Susan finishes up here, we'll start asking these guys these questions that you may have. Without further ado, ladies and gentlemen, Susan May-Mclean.
Thanks, Anthony.
You're so
Jonathan,
welcome.
I'm going to start with you. Given the current climate, what are the lenders doing to mitigate some of the risks?
That's a good question, Susan. We're in a transitional time now. As if we look at New York as an example, we're moving through COVID with a lot of state and federal restrictions on how lenders can exercise remedies. So normally, if a borrower defaults to a lender, the lender has all these remedies in their security instrument or their mortgage and loan documents. Today, the state government and the federal government has disrupted the lender's ability to get to the properties when a borrower defaults. So the loans that are being underwritten today have to keep this in mind, that in the short term, they'll likely not be able to foreclose on tenants and grab the property or bring the borrower into a legal proceeding that could proceed forward with all the moratorium. So a couple things we're recommending when we do a closing. One, higher interest reserves right now. And that's in order for us to bridge the short term while this moratoriums keep in place. Number two, pledge of an interest in the borrower. A UCC pledge is not restricted by all the rules that are in place today. So that foreclosure can go forward. And the other thing is we're encouraging our lenders, you can still move forward with the foreclosure or the forbearance process, but you're going to have to wait. But there's no reason to wait to get it started. Get it started. Talk to your borrowers now, the ones that can't pay because of COVID restrictions or otherwise, and work with them. But this will get lifted and we will move forward. But there's definitely short-term issues that lenders have to deal with their clients.
Okay, Tim, where are the biggest opportunities for investors that you're seeing, and what property types are they having success with?
Sure. So where physically, we were talking about this before the call, Susan, physically, we're seeing the biggest opportunities in sort of the red states, right? And I think even Jonathan was talking about the states, and I have them listed here. You know, Texas, Florida, North Carolina, South Carolina have been very hot for us. I'm starting to see things out in Missouri as well. But when we're not talking about geography, some of the biggest opportunities that I'm seeing are, you know, with this lack of inventory, we're watching our borrowers get very clever, meaning we're seeing the borrowers who go into, if it's a flip, they're going in with the idea that they're adding square footage, right? So they can now expect a higher ARV. that higher after repair value, and thus they can bid more and win these contracts. So the biggest opportunities, I think, will always remain in the single family residential, just because of the lack of inventory there. However, we're seeing, some of my borrowers who do 20 to 50 transactions a year are now starting to hunt down those duplex up to fourplexes because there's a little bit less competition there.
Jeff, what financing options are currently available for investors, and what are the typical terms that you're seeing?
Yeah, so today what has changed somewhat over the past really couple of years, this is pre-COVID, is the investor community across the nation, especially the single family investment community, transitioning from the buy, repair, and sell model to often buy, sometimes repair, but aggregate single family homes for long-term rental purposes. The aggregation that is occurring of folks building out portfolios across the United States, and this includes here in greater New York City. Just because the values are higher doesn't mean that this is not occurring here. It's actually quite breathtaking. Let me give you an example for a minute, Susan. So if you take a look at what RCN was originating in the calendar year 2020, we started off the year somewhere in the neighborhood of about 40% of our origination being longer term debt on single family homes, to post-COVID, meaning September, October, when the real estate market had really recovered from the financial market shock it experienced in late spring into the summer, to almost 60% of our origination being long-term debt. So it had totally flipped, 40-60 going into the pandemic to now 60-40. And what that tells us, Susan, is our investors across the United States are betting on the single family home as long-term generational wealth. So while it's always great to take your chips off the table when you acquire an asset, rehab it, and then put it back into the marketplace for a quick profit, what we're seeing is the investment community taking that long-term view that the single family American home not only has value today, but is going to have value for the long term. And of course, we've structured our products accordingly. So before, we had the short-term product that allowed investors to buy a house with as little as 10% down and 100% rehab funded. Today, we have 30-year debt with experienced investors locking in that money in the fours. Think about that for a minute. 5-6% for 30 years on a single family investment home, locked in today, no matter what happens going forward. So we've really seen that really be quite the change. John, my guess is with all the lenders you're closing for, you've seen that shift in short-term versus long-term closings as well.
Post-COVID, Jeff, the DSCR product, or the longer-term product, was definitely more desirable. It came in quick. It came back quicker than the bridge and the fix and flip. But as Tim said, so the red states, you're seeing more fix and flip activity because the places, Texas, Arizona, Nevada, Georgia, it was a red state. This election, you could go through it. Florida, all those states are seeing a lot of bridge activity and still strong market fix and flip. But in general, what you're saying, the longer term DSCR product is flying out the door. The 30-year is in high demand, and it's directly tied to the real estate market, right? The residential real estate market, there's high demand for home ownership today. There was a flight from the cities to the suburbs, and there's a lack of new construction, and new construction doesn't happen overnight. So when you have someone who's in New York City who wants to live in the suburbs, a lot of times they're going to buy something and invest in it and fix it up versus waiting for a ground up construction. They don't want to wait. So that's what we're seeing a lot of activity for, and we have not seen that trend stop yet. And I think you're going to see that continue until the city stabilizes again, until it's comfortable to go back to Manhattan and live the New York life that so many people want. But I agree with you 100%.
Yeah, absolutely. And before I kick it back to you, Susan, Tim, as a partner of ours, you're deploying capital all over the place. What are you seeing from a short-term bridge versus long-term rental?
Yeah, so Jeff, it's sort of a self-fulfilling prophecy too, right? When RCN starts offering money at, and the number is actually 4,375 right now, we're actually really incentivizing and encouraging people to want to, hold that rental long-term. Couple that with the fact that, look, employment numbers aside, a lot of folks lost their jobs last year, and that frightens people. And they're sitting on a significant amount of wealth, whether it's a 401k, Roth, whatever, and they're deploying that into real estate. Because as you and John pointed out, that's how you build legacy wealth, right? And so it's sort of a perfect storm. And I'm not giving people tax advice. However, if you flip that house and you're going to make 90,000, there's tax implications to selling and seeing that 90,000 short-term gain. However, if you decide to hold the house, put it into a 30-year at 4.375, you're kicking that tax can down the road, right? Because when you do the cash out refi, even though you may walk away with 50 or 60,000 in profit, that's actually debt, right? So again, I'm not giving tax advice, but we're basically, I don't want to use the word forcing, but we're strongly incentivizing folks to hold these as rentals. I have borrowers who, and look, Quickline, we talk to about 200 borrowers a month, hopefully potential borrowers, funding maybe 15 or 20% of them. But one of the things that we see is, folks who had never wanted to be a landlord are accumulating properties and building 10, 20, 50 unit portfolios quickly because of this leverage that they can get on their.
It really is amazing, Susan. So that's a little bit what's going on with products today. It's really been quite the shift.
One of the things I've seen you had mentioned that people don't want to wait for the new construction. I found that there's been an element of panic to get out of the city. So that has put people in a position where they're buying things that they may not love, and they're putting all their money in there, and they just they need to get what they can get. I mean, especially out east, we've seen insane bidding wars. New Jersey, the same thing. But
that Susan, that's not going to change until New York City changes its view on a lot of different things. People have to feel safe in the city. The restaurants have to be open. The theater has to be open. Be a reason to live in the city. And right now, there isn't. And even offices aren't open in the city and running the way they are. So a lot of help. And I'm hoping the leadership, both at City Hall and on the state level, will recognize this and actually step up and promote it, and don't continue to put restrictions on, to put a Band-Aid on a social problem right now, because it's going to negatively impact the city long-term. And look, everybody here, everybody on this call is vested in New York City succeeding. It's great for everybody. I love to go to dinner there. I meet my friend Jeff Tesch there all the time. And we haven't had a dinner in the city in, I don't remember the last time. He's had to come in New Jersey, which I know he doesn't like to do so much. So I mean, this really needs to turn back, and hopefully it'll happen sooner rather than later, but I'm not as optimistic as some other people may be.
Well, Jonathan, can you give us an update on the legislative changes that may impact real estate transactions, especially the anti-flip and fix and the Senate Bill 5470 and the other S1061?
Yeah, these are all, that's really, Susan, great question. So that's a good lead into what I was just talking about. What you have, and for full disclosure, I'm an elected mayor in New Jersey, for those of you who don't know. I'm the mayor of Mark. I have vast experience in government, and I know how it works. And what's happening is you have people suffering with But then you have state legislators just putting forth legislation to fix the immediate problem without thinking through the long-term ramifications of what's going on. So let's talk about it. Last year, there was a bill introduced by a senator in Brooklyn called the anti-fix and flip legislation. What it did is it restricted how long a property until could be sold. So a property bought would need to be held a year, it would be taxed a certain way, 2 years taxed another way, and then after 2 years, there'd be no tax. So it affected the transfer tax, a high tax if it was flipped within 12 months, less of a tax, 12 to 24. This would have killed the speculative market to invest in apartments or buildings to rehab them. Now, it's hard enough to attract investment capital into certain urban areas. And this law would have shut it down completely. Now, I'm not sure who that helps ultimately in the long run. I will tell you, it makes it less desirable for investors to improve streets and areas that need help. So that's number one, but that has not moved forward thus far. The second one is Senate Bill 5470, which is the commercial financial disclosure. Again, a state bill came forth and said private lenders have to disclose, similar to federal TILA requirements, what the APR is on rates. And the borrower would have to sit there and have a 3-day waiting period. Now, everybody on this call is only doing commercial transactions. We don't need to treat the borrower like they're consumers and unable to read the loan documents or understand the transaction. These are business purpose loans. That kind of legislation only disrupts the natural flow of transactional work. It's difficult to close deals. So that was actually, with our firm's help and the National Private Lenders Association, they kept private lenders as real estate loans secured by real estate as an exemption to that law. So it's not applicable. And the last one, which has just been reintroduced this year, is requiring private lenders to have licenses in New York to operate. Now, I am admitted to practice law in New York. I've always practiced in Manhattan and around the state. And I will tell you that New York real estate lending is some of the most regulated lending in the country. It has a large body of cases way back when Manhattan was formed, and all the rules and regs are out there. We don't need additional legislation to restrict private lenders from entering into commercial transactions. So my firm monitors this on behalf of the National Private Lenders Association, where we serve as general counsel, and Jeff's a part of that as well. What we do is we flag this stuff, and then we go right to Albany. We have lobbyists up there that we speak, and we try to get our point across on all this legislation. But if we don't monitor this stuff, you'll see one day you'll see that we won't have an industry to go back to because it'll be so regulated we won't be able to transact, and that hurts everybody on this call. That's how Manhattan grew. It's not what the United States is about, and we have to be careful about that and monitor it. So we're engaged in that, and we will continue to be.
Do you feel that you're being successful in getting your point across?
Yeah, I think
you're getting
so.
Some headway?
You'd be shocked how many state elected officials have no idea why bills read the way they are. Like they have no idea. They're sponsored by elected officials, but they're drafted by staff, and the staff just throws anything in there, and the stuff they're throwing in has real world consequences. And they just aren't experts in the transactional world, know what their restrictions are actually doing. And that's what we have to, and that's what we need to educate them on. So we prepare these opposition memos and we speak with them. And I think we've been successful, but it's a full-time job in itself. It's like you got to monitor this every day because every day someone's introducing something else. And but we're on top of it as much as we can, and we will continue to be.
Great, thank you. Jeff, despite the inventory issues, what areas of the country are you seeing the most opportunities for investors right now?
Sure, and I'm just going to follow up from John's comments there. When we built our company, all the way to today, a tremendous point of pride for RCN has been the literally thousands and thousands of, just beat up, dilapidated homes that were unfit for living, that we've provided the capital to local contractors, investors, the people in the community who take a home that is unfit for a family to live in, and through the monies that we provide, they buy everything that goes into it, the carpet, the roofing, the new kitchens, the baths, and families move into these homes, providing a tremendous service to the community. Now, don't get me wrong. We're in the interest of providing capital in return for interest charge. But we grew from that foreclosure crisis today, and it's no different. Our mandate is to provide capital to take a housing stock that needs improvement so that families can live, and it's a point of pride. And to John's point, anything that gets in the way of that free flow of capital, providing the necessary means to transforming that housing into today's standards, is a detriment to that local community. So I just wanted to add that in.
Jeff, you're so on point. The social element of what everybody does on this call is so important, and it's always missed. That does the legislators putting forth this restrictive legislation don't even consider it. They're looking to protect the end user consumer, but they're missing sight of the benefits that are happening because Jeff is providing capital at 4.375% long-term capital. That's cheap. And that helps change, and that helps stabilize neighborhoods. That's not hurtful. And it's that is lost on a lot of people. Maybe they don't understand, but it's our job to make sure that all the elected officials understand the positive benefits of what RCN Capitals and others like them are doing.
Yeah, you're so right. Susan, to answer your question directly. So, what are the hot markets right now? So a lot of folks refer to it as the smile across the United States. So you sort of go from the West Coast all the way down and then up the East Coast. Some of that's correct, some of it's not, because some of today's markets you wouldn't think of as being productive hot markets. I'm going to throw out the state of Ohio. For whatever reasons, and we don't drill down into why economies are doing so well, but the state of Ohio has had a resurgence. Columbus in particular. A lot of it's driven by Ohio State. It's a big university town, but it has also grown up. They attracted an NHL franchise and all the things that come along with that sort of stature in their communities. We're seeing a tremendous amount of activity in the state of Ohio. And then I just wanted to throw that out because people view it as a Rust Belt state. Well, it is, but it is really graduated. And I'll also throw out the city of Pittsburgh, another area that was always considered sort of behind the times. Tremendous resurgence, seeing a tremendous amount of activity in not only short-term bridge, but as well as longer-term rental aggregation. And then we'll go to the usual suspects, those smile states. So you start out west, and California has a host of challenges right now with price. But let's look at Arizona. Phoenix, folks on the call today, no matter where you live, you need to understand that the greater Phoenix area is hands down the hottest market in the United States. It is absolute. They can't build the houses fast enough. And the appreciation in the existing homes is at a really a breakneck pace. And then you just work your way across. Obviously, Texas, well documented. It's not any one particular area in Texas either. You start at the top, you work from Dallas, Fort Worth, you move your way down to Austin, you move your way down to San Antonio, and then across to the Gulf in Houston. All the way down I-35 and across to Houston, tremendous aggregation of single family homes for rental, as well as improving the stock of housing. You move your way into the sort of the Gulf states. I'll tell you, we've done more business in the state of Alabama in the past 12 months than I think we have done in the lifetime of RCN Capital, especially once again near those urban centers, university towns, University of Alabama, Birmingham. Many of these communities resurgent, folks moving in from different parts of the country. And then you work your way across down the Panhandle and the entire state of Florida, from Jacksonville across to Tampa, the Tampa, St. Petersburg right now. You can't, houses, multiple bidding. And these are houses that were often built 30, 40, 50 years ago. Cinder block housing, 1,500 square feet, multiple bids. And then, of course, you move down to Miami-Dade and across to Naples, super hot, and you work your way up the coast. Atlanta, long-term, it's been doing fantastic, continues to do. Raleigh, Durham, Charlotte, spectacular. Actually, you go into the greater, you go up from Raleigh up into Norfolk, military town, right? Doing very well. Lots of folks loving that coastal living, affordable living. Washington, D.C. continues to be hot. And then it kind of peters out when you come up into New York, New Jersey. While New Jersey's doing well on the single family side, some of the urban centers have taken a hit. We're not seeing as much attraction on the multifamily. New York, once again, urban centers not doing as well. But, for example, even in the city, we're doing quite a bit of business out in Queens, single families, backyards. Even though you're in the city, you're seeing quite a bit of attraction for that. You work your way up into Connecticut. Connecticut's cool again. It's where we call home. Folks loving the backyards, and all the way up to Boston, doing quite well. So really, Susan, it's interesting how areas that were once considered not applicable for gentrification really are, especially those Rust Belt areas.
Jeff, I absolutely love that, because as you're going through some of these, non-traditional or sort of, like Ohio, for example, I'm thinking of borrowers in every single place that you mentioned. I like to think that Quickline has been very helpful with Ohio. An interesting aside is March 15th of last year, I was in Ohio opening an office in Cincinnati. Maybe a week or two later, really the COVID impact hit, and I did hit pause on that. But it's funny, we have a borrower in Ohio, and, I'm going to get to the personal side of things. You're definitely spot on about everything that you said. But look, I have she's a young African-American woman in Ohio. Her name is Tennille, and she's buying up the state of Ohio, whether it's Columbus, Cincinnati, and she's flipping, and she's got phenomenal taste and has been enjoying some tremendous amounts of success. And then you've gotten down to Alabama. Well, I have a woman, she's in her 50s, she's disabled, and she's flipping in Mobile. And it's just fun to hear you talk about this. These hot spots that I like to think that, Quickline is sort of helped, occur. But there's a personal side of this. We're talking about all of the wonderful benefits of these of these properties. And John was very, on point with those. But, aside from increasing the tax base and aside from increasing properties, we're creating generational wealth for the borrowers, right? Tennille is never going to look back. She's adding to her portfolio with the high leverage products that we're getting and those low interest rates. She's now holding them. You talk about New York, and we love to talk about New York City, but as you know, I'm in upstate New York, and we're just killing it up here. I have a borrower, another woman who about 8 years ago went through a divorce, really didn't have much of anything. Today, she's got a portfolio of about 50 properties, and she's flipping another 15 or 20 a year, most of which are funded by you, Jeff. And here's a woman who she's now heading towards her 50s. She'd kill me if she knew I said this, but she's her name is Rebecca. I call her the queen of real estate. In fact, I decorate my office with my borrowers' flip.
Oh, wow.
Nice.
Tim, I love the fact that everybody you're mentioning are women.
You know what's funny? And then this is why I wanted to mention that, Susan. We're talking a lot about the business side of things, but we don't obviously track this, but I do try to meet as many of our borrowers as possible, even during COVID, safely, of course. And it's, I think it's a disproportionate amount of female-owned businesses that I'm funding, also minority-owned businesses that I'm funding. So there's just such a huge personal side to this. That look, these are easy products to sell, right? But the lives that you're changing, Jeff. I mean, honestly, I wish you could meet more of the borrowers that we have. They come up all the time to visit, or I go down to visit them. Next time I'm anywhere near Connecticut, I'm dragging you along.
I love it. And hey, shout out to Buffalo, right? Go Bills. I might add, the Buffalo Bills are the only team that actually plays its games in New York State. And that's coming from a Giants fan. I might add that, right? But the reason I bring up Buffalo, Tim, and you're seeing it, tremendous resurgence in Buffalo. Homes are being rehabilitated. Buffalo has definitely made a great deal of progress pre-pandemic. It's really amazing.
Yeah, absolutely. Again, I have this national reach, but because we're based here, certainly we get a disproportionate amount of deals. Buffalo, Rochester, Syracuse, over to Albany, and on down into the Hudson Valley. So as much as John doesn't like us talking about anything outside of New York City, there is a big state of New York north of Westchester County.
I'm starting to see some activity more on one bedrooms in the city. I've seen a lot of people make the exit with their families and go to New Jersey or to Connecticut. But they believe in Manhattan and they know they're going to come back to work here. So they're getting pied-à-terres. So at least that is something over the last month I've seen a big uptick in, which I'm really happy to see.
Not surprising. New York's not going anywhere. New York.
No.
We're going to be back. We will absolutely be back. People thrive on that human connection, and nobody in the United States is better than New York City at that.
I agree. We have always recovered quicker than ever anticipated, and we will again. But Tim, I wanted to ask you, are you seeing an increase because of the popularity of the BEAR strategy, and what is that?
Oh, the BEAR strategy. Yeah. So it's
BEAR.
like
BEAR.
No, it's fine. So BEAR is basically a strategy that a lot of borrowers are using right now. It's sort of the hottest thing in this market. And BEAR stands for buy, rehab, rent, refinance, and repeat. So as we talked about some of my women borrowers, whether it's Tennille, Rebecca, or April, these women, all of our borrowers, they're incentivized now to hold this property as a rental rather than just sell it for that quick profit. There's tax implications, but they're also looking at long-term, right? And, in years past, their options were they've got a nice product, they've just flipped it, and they can go to the community bank and they can get a 30-year loan. Well, that community bank is really going to be focused on their income, going to be looking at their tax returns, very concerned about their debt to income ratio, where RCN type product is really just looking at, hey, does the property make money? Does it perform? Is the borrower credit worthy? And if those answers are yes, then they're going to get some pretty high LTVs, 75 and in some cases 80% at 4.3. When we're talking about markets outside of New York, that 4.3% is really doesn't make a big difference to their borrowers, whether it was 3.3 or 4.3, because they're making so much money. We're lucky enough to enjoy, sometimes 2 times debt service coverage ratios once we get outside of the major cities. And at that type of income, that's even more incentive for folks to keep the properties long-term. So they got the tax implications, but more importantly, they're building portfolios of, in some cases 30, 50 homes, which, look, that's cash flow, and they've got this, retirement or legacy wealth for their family.
Yeah. Passive income. Can't have enough of it.
No, and you know, one last thing, because we don't really talk about it anymore because everybody on this call, we're all used to it, is the lack of seasoning now, right? So it used to be the flipper was done with the property and they had to wait 3 months, 6 months, sometimes a year before they could refinance it. Today, with products like what RCN is selling, you know, the day they're done with the rehab, if they've got a renter, they can now refinance it at 75 or 80% of the new value. There's no seasoning period for that property. So why that's important is, again, it allows people to draw that new equity out of the property and to deploy it to go get 2 more properties. I mean, if they're doing a flip properly, when they refinance and hold it as a rental for this BRRRR strategy, they should be getting back their entire down payment for their flip loan. If they're not, you know, that's a very unusual flip, because typically both myself, I would help, and also RCN would help. We typically wouldn't want to loan to somebody where we don't think that they have a decent chance of doing that.
All right. Anthony, I think we put a lot of information out there, and
Great.
maybe we should open it up to our viewers, see if they have any specific questions.
Good. You know, I do have, unfortunately, they have about like quite a few people that weren't able to jump on, but they did send in their questions. You know, Jeffrey, a lot of these are for you. And one of them is all the improvements, they must be permanently affixed to the property. Is that correct? Can they be a pool? Can they be landscaping? Can it be a driveway?
Yeah, so that's a good question, right? So what does a rehab constitute, right? What are we going to fund as a lender? So we're going to fund pretty much soup to nuts, from the trash out when you're initially demoing, all the way through the construction period, including, you know, permits, all the way to septic system if it's needed, all the way to driveway to final landscape. We're going to fund all of that. And what we really pride ourselves on, Anthony, is being that partner who looks at the rehab list on the front end, takes that completed scope of work, hands it to our appraisal department, and comes up with a value that we think that house is going to be worth when it's completed. And the value there, especially for the newer folks buying and renovating, is it's another set of due diligence that allows the borrower to say, you know what? The lender thinks the property is going to sell for this. I think it's going to sell for this. And if those two numbers match, Anthony, then most likely the chances of the investor making money are pretty darn good. It's really about that partnership of evaluating the scope of work and making sure it makes sense, not only for the property, but the surrounding neighborhood.
I know that client asked, you did answer 2, landscaping and driveway.
Mm-hmm.
What about the pool?
Yeah, we typically do not finance new pools. If there's an existing pool, we will fund the renovation of that pool.
Okay, yeah, that's what they really meant. Okay, thanks, John. That was good.
Yeah.
Right now, what property types are most desirable and least desirable right now?
Tim, I'm going to let you take that.
So most desirable remains single-family residential. Lack of inventory for the most part, because, you know, as Jeff was talking about, we help them with their ARV, give them that sort of extra insurance policy that this number is valid. But what we're seeing is, even when they're done, even our high estimates, they're exceeding them because they're setting all new comps, because there just isn't inventory on the market. However, you know, we have flippers. This is their business, right? They have to flip 2-3 homes a month or whatever size of their company is. So they're now going into the condo market. We're seeing a lot more of that than I've ever seen before. But also the multifamilies, when they come up, it's a more rare property type for most of the United States. But when they are coming up, they're getting snatched up as well.
Okay, one of the questions from William Fleischer. We are surety brokers. Question, do you require a site improvement bond to make sure the work is completed?
So I'm going to answer that from an RCN perspective, then I'll hand it off to John because John sees a much wider scope of lenders. We typically do not require that as one of our requirements at RCN Capital, but John, do you see that with other lenders?
So most lenders rely on a corporate guarantee of some sort, a personal guarantee or a corporate guarantee, as far as requiring a bond. Interesting enough, though, just the last 2 weeks, I've been asked to look at 2 deals that included a surety bond instead of a guarantee. And my guess is the guarantor's credit wasn't worthy enough, valued enough, so they had to go to a third party for credit enhancement. So it is the exception, not the requirement. Let's just stop for a second, point out, this is for rehab. If you're talking ground up construction, we may be requiring it. So this is only for rehab, which is usually, 20 to 40% of the value of the property. It's never going to be 100%. So that's the one caveat, but it's the exception more than the rule.
Jeffrey, staying with the construction, what John was just mentioning, Long Island City, 2 families, 3 families being converted to 6, 7, 8, 9, 10, 12. It is happening. It's booming. Can RCN help with that? Or is it just rehab?
Yeah, no, it's what we call heavy rehab. Especially in New York City, we see it a lot in Boston. Been seeing a ton of it in Philly. For those of you who are from the greater Philadelphia market, Philly is super hot right now. Folks are taking 2 families, 3 families with maybe 3 to 4 bedrooms. They're converting these buildings into 6 apartments to really stretch that rent out. We do these heavy rehabs all the time, Anthony, and we love them because the return on investment when you take an existing building and add additional revenue through additional units is typically off the charts. We love it.
Okay, because I was coming from a Queens broker.
Yep.
Your rates compared to a construction lender, are they competitive to the normal construction lender? Is RCN are you guys competitive to them?
Yeah. So I can't speak to what the typical construction lender is doing today. We typically only focus on non-owner occupied. So we're not getting into, folks who are renovating their homes and need a construction loan, anything like that. We're strictly non-owner occupied. But for most of our rates, we price them on the seasoning of the investor. The more rehabs that the investor has completed, we have tons of data that has shown once they get above 3, the chances of them failing is almost 0. Knock on wood.
Okay, good. Because
yeah, and that's how we price it out. And Tim, you can talk about pricing a little bit.
Good, that's good. Because these are basically 3 families, 2 families being converted to 10, 12, and they're all going to be sold. They're all going to be rented. They're all going to be sold or rented. So they're not owner occupied. So that's good.
And just to add to that, Anthony, it's super important when you get into these heavy rehabs that we see experience. We don't want someone who's been watching HGTV and decides that they're going to convert a 3-unit into an 8-unit, right? Like we all love Flip Flop and all the rest of them. I even watch these shows. My wife loves them. But at the end of the day, we're looking for seasoned investors for these heavy rehabs.
Correct. Of course. Chester Lowe, by all means, I will definitely send you everybody's email here and their contact information. So I will definitely get that out to you. And I guess you have some investors that you need to get funded. So by all means, Chester, I'll do that. You're welcome.
Call me Chester.
There you go. Again, Jeffrey, is there a minimum required repair requirement or in a maximum? Is there a minimum and a maximum?
Yeah. So when it comes to the scope of work on the rehab list, there is no minimum amount of work that we require from investors. That is really determined by the amount of deferred maintenance that is in the property. And once again, we have an evaluation team that goes into these properties nationwide. They determine what your scope of work is going to match with the deferred maintenance to make sure that all equals. No minimum amount is required, especially if the borrower is buying it right.
You may have already answered this question. What percentage does RCN offer again? Is it 70, 75, 80% before and after the improvements?
Right. So Tim, I'll let you dive into those numbers.
You know I'm dying to talk. Thank you. I appreciate you, Jeff. So, one of the things right now, if we're talking about the fix and flip product, most borrowers without experience are going to get 85% of the purchase price. RCN always funds 100% of the renovation. Even if they don't draw it, they don't have to pay interest on it. However, we want that cash set aside so that no matter what else happens in their lives, they have the money there to finish their flip. If they have experience, as Jeff pointed out, we know that it's a much less risky loan. So they're offered 90% of the purchase price, and again, that 100% of rehab.
Thank you, Tim. Again, you may have answered this. Is rental comprising a bigger piece of origination than flip in fix and flip?
Yeah, I'll answer that quickly, and then I'll defer to John because John sees a much wider basket of lenders. He could add some color there. But as I mentioned earlier, we've seen a 180-degree flip. Pre-pandemic, we were at about 40% rental, 60% short-term bridge, and now it's about 60% rental, 40%. And that really started late summer when we were starting to hit, new records again for RCN originating production. And it really took us by surprise, Anthony, because clearly the investment community across the United States is making a statement that they believe in the strength of the single family home. They believe in the strength of how that asset is going to perform over the long term. And it's being borne out in the numbers. John, what are you seeing from your lending community?
I'd say you're spot on. I mean, if I was going to ballpark it, I'd say 65% DSCR, 35% bridge. I'd say that's right. A little more towards the bridge. I think you have, in the Phoenix area, in the red states, you see a lot more rehab and bridge stuff going on than long-term DSCR. So, but I'd go 65-35 right now.
Thank you, John. Guys, that concludes my questions that were sent in by people that were unable to attend the webinar. And I'm just checking to see if there's any more questions here. And if there are any, guys, we could answer it. But I really want to thank you guys, Tim, John, Susan, Jeffrey. Yeah, thank you so much. Very informative, always informative to hear RCN, especially, and Susan when they come on and conduct one of these webinars with our firm, the NYC Real Estate Expo. Susan, of course, is going to be having many more of these presentations with RCN and many other professional organizations. So we look forward to having her again and again. And I just want to thank you all. Thank you all. And there's a tremendous amount of people that did register that were not able to attend as well. Everybody will get everybody's contact information on this panel, and you'll also receive a copy of this video as well. So I want to thank everybody for registering, and thank you. Thanks
Thank you.
Thanks, guys.
It was a pleasure spending this time with you guys. Thanks a lot.
Good to see everybody.
Invite me again, Susan.
Okay.
Thank you, Tim. Thanks, Jeffrey. Bye-bye,
Thanks,
John.
everybody.
Bye,
Bye.
guys.
Bye-bye.